Hi everyone, welcome back to the channel. Today we are going to talk about the Federal Reserve System, also known as the Fed, and how it works. The Fed is an independent organization that plays a critical role in the United States economy, and unless you live under a rock, you've seen how things have changed pretty quickly. Many people do not understand how it operates. So in this video, we will explain what the Fed is, its functions, and the impacts on the economy. So what is the Fed? The Fed is the central bank of the United States. And I know that sounds complicated. It was established in 1913 to ensure a stable and secure monetary and financial system in this country. Basically, to make sure that our life is nice and cushy and that the monetary system around us doesn't collapse. The Fed is an independent organization, like I said earlier, which means that it is not controlled by the government or any other political institutions, despite the stuff that you hear in the news about Democrats and Republicans arguing over what the Fed's going to do. They don't really have any input. The Fed is headed by a board of governors. Now, that board of governors, which you've seen some people speak on at certain topics in the media as of late, that consists of 7 members. And those 7 members, they're appointed by the president and they are confirmed by the Senate. So they certainly have to go through their trials and tribulations to get there. Now, the functions of the Fed are pretty clear and well known, but I think a lot of people don't understand how broad their power actually is. So number one, it's monetary policy. The Fed is responsible for setting the country's monetary policy. This means it does this by controlling the money supply, adjusting interest rates like we've seen with the Fed interest rate increases, and managing inflation. And their target since the days of Ben Bernanke has been 2 to 3%. Then they have supervisory and regulation responsibilities. The Fed supervises and regulates banks and other financial institutions to ensure their stability and prevent financial crises from happening. So what does that mean? They set the policy to make sure the overall economic climate is good, and they also make sure that the banks don't fail in addition to that. They also have some payment services, and this has recently been important in the news because crypto banks have been denied access to these payment services. The Fed provides payment services to banks and other financial institutions such as clearing and settling of transactions. And so many crypto businesses want to have access to that because they feel it legitimizes crypto and gives them direct access to our monetary system. And for the foreseeable future, that's not happening. The last is economic research responsibilities. The Fed conducts economic research to inform its monetary policy decisions and to better understand the economy. So they're responsible for not only digging up the research and doing all the due diligence, but they're also responsible for taking that information and implementing all these things we talked about to give us a better and more secure system. So how does it actually operate? Well, the Fed's main tool for controlling monetary policy, and I laugh a little bit here, is the federal funds rate, which we've seen be increased at a historic cadence over the course of the last year. This interest rate is the rate that banks charge each other for overnight loans. And this is not a direct impact to things like the treasuries, but it certainly does influence treasuries, which then in turn influence things like mortgage rates, which we all care about when we go out to get a loan. The Fed uses open market operations to adjust the federal funds rate. It does this by buying and selling government securities on the open market, which increases or decreases the monetary supply. There's also quantitative tightening and quantitative easing, but for the purposes of this conversation, that's all you really need to know. Now, the Fed does have some additional responsibilities. They also set the reserve requirements, which are the amount of money that banks are required to hold in reserve to meet the customer's demands for cash. This to ensure that banks don't have a run on liquidity and not have enough money in them in order to pay out the people who want their money back. The Fed Board of Governors, as you probably know now, meets pretty regularly, not every single month, but certainly every 45 days or so, to discuss the economy and decide on these monetary policy changes. They may choose to raise or lower interest rates or adjust reserve requirements or use any of the other tools that we talked about to control the monetary supply. What you've noticed most recently, however, is the main tool that they typically use is that Fed funds borrowing rate. So the impacts of the Fed on the economy are very, very clear and simple. The Fed's monetary policy decisions have a significant impact on the economy, and if the Fed raises interest rates like you've seen recently, it becomes more expensive for consumers and businesses to borrow money. What does that mean? It can slow down economic growth and reduce inflation. However, inflation can become sticky like we've seen if the things that lead into it and for that aggregate total number to come together aren't actually actually going down. Like, for example, home values. If home values don't go down and they make over 30% of the calculation of inflation, well, guess what? Inflation doesn't go down. The Fed's actions can also affect the stock market, although not directly, and other financial markets. For example, if the Fed cuts interest rates, it can boost stock prices and encourage investors to take on more risk. As they've been raising interest rates, the opposite tends to happen once the optimism is out of the market. Last but not least, the Fed's role in regulating banks and financial institutions can also help prevent financial crises and maintain a stable financial system, which is the narrative the Fed has been providing everyone. They've been trying to provide a soft landing because they believe that inflation was transitory. Now, I think a soft landing is relatively out of the question, and frankly, inflation is not transitory. It's going to be here for a while. So in conclusion, that is a brief overview of the Federal Reserve System and how it works. I hope it provides you some insight into what you're seeing, a little bit more context than what you generally get from the media. While the Fed may seem like this complex and obscure institution, it plays a critical role in maintaining the stability of the U.S. economy, and that's why you're hearing so much about them in the news today. Understanding how the Fed operates and the impacts of its decisions can help make a better financial decisions and prepare for the economy and the changes that you see up ahead. Okay, so if you understand these things, you can do better. Recessions are scary, but that doesn't necessarily mean that it has to be bad times if you understand how these things work at their core. Thank you for watching, and don't forget to subscribe to our channel. And for more information and videos like this, you can like, subscribe, and follow, and please share with your friends.